Greetings and welcome to another installment of Viewpoints by Hennessy. I'm Eliot Bishop, Portfolio Strategist at Hennessy Funds, and I'm joined today by Ryan Kelley and Josh Wein from the Hennessy Cornerstone Growth Fund. Gentlemen, thanks for joining me.
Thanks for having us.
So Ryan, let's start with you. Can we please just walk the audience back through the fund's investment philosophy?
Sure. So this is one of our cornerstone funds, which means that it follows it's a formula-based approach to investing. In this case, we're trying to combine value with earnings growth and momentum when we build the portfolio. It's really focusing on what's worked over time. So this fund has been around for almost 30 years now. It was started in November of 1996. And since day one, we've used the same consistent, repeatable, and understandable investment process.
And then Josh, specifically, what is the construction process for this fund?
Sure. Yeah. So as Ryan said, since 1996, for 30 years now, we've been using the same rules-based framework. And it starts with looking at companies that are greater than 175 million in market cap. We're then looking at companies with a price to sales ratio of less than 1.5. And then from that list, we are looking at companies whose earnings were improved from the prior year. So any improvement in earnings. Then we're looking at names that had positive 3 and 6 month price appreciation. And that will bring us to a list of most likely well in excess of 50 names. And then we rank those names by 12-month price appreciation. And we take the 50 with the highest 1 year price appreciation. And then we rebalance or reconstitute the portfolio on an annual basis.
Then Ryan, with the formula-based approach, what is the goal of this strategy?
Well, we're trying to provide investors with consistent returns over a complete market cycle. So this formula itself will often identify some interesting turnaround stories, whether it's individual companies or whether it's actual sectors or industries. And it's really trying to focus in on stocks with strong and consistent upward momentum. That's what Josh had talked about, that are showing at least some sort of earnings growth and are trading at a very attractive price to sales ratio.
And then as a follow-up there, so why is the price to sales ratio so important?
Yeah, well, we think, for price to sales, first of all, it's a very simple formula. It's very easy to understand. Generally, a company's sales or revenues are more difficult to manipulate than earnings. It allows us to compare companies across many different sectors and many different industries. And overall, it's actually a fairly restrictive metric. Right now, if you look at the S&P 500, only about 1/3 of all the S&P 500 companies out there trade less than 1.5 times price to sales. So, one question we get often is, well, if you're only focusing on such deep value, are you going to end up with some companies that are considered value traps? And we generally don't, because the other part of the formula is momentum. So these may be companies that are trading at very low, very stringent price to sales valuations, but they also have 3 and 6 and 12 months price momentum. So we're not going to buy a stock before it bottoms. We're not going to buy a stock right at the bottom, but rather it'll be included in the fund once it's already turned.
Got it. And then Josh, I know the fund just went through its annual rebalance recently. So what's the current composition of the fund now?
Yeah, so post rebalance, as is usually the case, the 3 largest sectors that the fund is invested in are about 60% of the portfolio. So industrials are just about above 20%, energy roughly 20%, and then information technology slightly below 20%. So and within each sector, there's plenty of diversification, which we can talk about. But ultimately, the fund is exposed to 10 of the 11 GICS sectors, with the exception of utilities. So there's no exposure to utilities. But within industrials, we own names like Pitney Bowes and FedEx. In information technology, some contract manufacturing companies like Jabil and Sanmina, which have been beneficiaries of what's going on in all things tech. And then a name like Dell, which is a name that I think in a way people forget about, but they are riding this wave as well in terms of equipment manufacturing and, selling, monitors and peripherals into big, hyperscalers.
And then Ryan, how should investors look at that overweight to industrials currently?
Well, like Josh said, typically we do have a high concentration in this fund in certain industries. Over time, industrials and consumer discretionary have often been some of the largest portfolio concentrations. Right now, the industrials, I think, should continue to benefit from a robust capital spending environment across many different parts of the economy. For AI infrastructure and data center build-out. Continued reshoring of manufacturing, electric grid and natural gas transmission expansion and modernization, and of course, right now, defense spending by the government. So all of these things should be beneficial to industrials in general. Our fund in particular has significant exposure to construction and engineering, to larger trading companies, and also to defense, as well as many other industrial companies.
And then Josh, you mentioned an energy allocation. What specifically is that comprised of?
Yeah, so our energy allocation is just over 20% of the portfolio across 11 names. And I think, to be sure, there's plenty of exposure to the price of oil and natural gas. We do have exposure to the traditional exploration and production companies. But I think it's also important to note that it's a fairly diversified energy allocation. So we have oil field services, drilling services, a specialty chemical name, and refining. So we're playing kind of the whole value chain within energy and not merely placing a large bet on the price of the underlying commodities.
And then Ryan, I was hoping to just move away from the portfolio specifically for a moment here. I know we recently conducted an investor flows survey. What did that study kind of tell us about our cornerstone funds?
Sure. Well, what we wanted to do when we were putting together this study is to get a better idea of our investors, our shareholders' experience compared to the actual fund's total returns. And what we found was that the strongest outcomes really come from shareholders who have stayed in the fund over the long period of time, over different cycles, rather than getting in and out at the wrong times. For instance, through the end of 2025, what we found is that for this particular fund, the Cornerstone Growth Fund, the institutional share class returned about 15.49% total return over a 5-year period each year. But when accounting for cash flows in and out of the fund, that actual return was reduced to about 13.34%. So about a 15% reduction in your total return because of investor flows in and out of a particular fund. This is something that's not just applicable to us. This is based on the behavior of many investors. One way I like to look at this, if you take a big picture point of view, is over the last 17 years, the S&P 500 has returned 17% per year annually. And I would be hard pressed to find many investors that have met or exceeded that kind of return in their own portfolio. So, bottom line, what the study really reinforced for us is that it really can be more beneficial to stay invested rather than trying to time the market in any meaningful way.
So Josh, advisors periodically ask me whether or not the Hennessy Cornerstone Growth Fund should be seen more as a core or satellite holding in a portfolio model. What are your thoughts there?
It's a great question. How to use a fund is of such importance in the context of a diversified portfolio. And I think it's usually assumed that a core holding would be one that closely tracks an underlying index, by virtue of tracking error or active share. And I think my view would be that provided that the portfolio is diversified across sectors and subsectors, it would clearly qualify as a core holding. And so I believe it's more core than satellite. There's no bet going on technology or energy. We are exposed to multiple sectors in that way. So yeah, I think a core holding, and then for those that want to layer on a bet on AI or biotechnology or whatever it might be, then that makes it, a lot of sense.
Got it. Thank you. Well, that wraps things up for today. Gentlemen, thanks again for your time. And for all of our viewers, if you'd like to learn more about either the Hennessy Cornerstone Growth Fund or any of our other investment strategies, please visit us on the web at hennessyfunds.com. Take care now.